Many people talk about investing in the stock markets to create wealth or financial independence. But what is the stock market and how does it work? Well, let's answer those questions. The stock market is a global network of exchange where large sums of money move in on a daily basis. The stock market does not trade of goods or services, they trade securities. Securities are rights to financial assets like a business share. A share is a portion of ownership in a company. When a person buys a share of a company, they are buying a small ownership in this company. But why are shares traded at all? In order to build a large, and I mean a large business, founders need resources. Imagine the company as a pie. The pie is divided in slices. These small slices of the pie are shares of the company. Companies typically sell their shares to raise capital to grow and expand their business. Many do this through an initial public offering or IPO. This is when a company begins selling a portion of their shares to public investors. In other words, the company goes public and anyone can buy parts of the company. And in order to facilitate the trade of these securities to the public, a company needs a marketplace to make their transactions. This is where the stock market comes into play. There are many stock exchanges around the world where stocks are traded in the US. We have the New York Stock Exchange and the NASDAQ in New York City and a few others in Canada, in India, and the JPX in Japan, just to name a few. These make a global exchange system where shares can be traded all over the world. This allows companies to raise money to continue the growth and expansion of their companies. For example, Facebook, in its initial public offering, sold over 421 million shares at 39.00 per share. This earned Facebook over 16 billion from investors. Typically, share values reflect how well a company is doing in business. As the company expands and grows in value, so do the individual slices of the pie. This is great for investors because it means that as the company grows in value, so does their original investment. But sometimes the pie gets so big that the individual slices also get big and expensive. This is when stock splits occur. For example, if you bought 10 shares of Apple right after they went public in 1980, you will now own 560 shares without any further investment. This happens when the company gets too big and their individual shares get too expensive for the average investor to buy. For example, let's say that you took your company public with 100 shares. You decided to sell 50 of these shares for $100 each as your initial public offering, but now your company has grown significantly. Secondly, and your shares are now worth 500 each. The average investor is no longer able to afford to buy your stock. So to make sure your shares are easier for the public to buy, you do a 2-for-1 split, which means that each share splits into 2 shares. Now instead of having 100 shares in your company now has 200 total shares. Splitting shares also means that you split the value of the original share by 2. Your $500 share after a 2-to-1 split are now 2 shares worth 250 each. DIS encourages more investors to buy your stock and continue investing in your company. Apple, for example, had their initial public offering on December 12, 1980, selling their shares at $22 per share. Apple had their first 2-to-1 split in 1987 when the stock hit 79 per share, reducing the share price 239.50 per share. This means that you bought 10 shares right after the IPO. You will now own 20 shares of Apple. Their second to the one split happened in that year 2000 when the stock was trading at $111 per share. This means that your original 10 shares are now 40 shares worth 55.50 each. Apple had a third 2-to-1 split in 2005 when the stock traded at $90 per share, dropping down the share price to $45 per share, meaning your 10 shares are now 80 shares at $45 each. And recently in 2014, Apple had a 7-to-1 split when their stock hits $656 per share, making your original 10 shares become 560 shares at the value of $93.71 each. As of February 2020, Apple stock is worth $327 per share. Now, stock prices don't always reflect the state of the company. A bad rumor about the company can bring its stock value down, regardless of its actual business performance. The opposite can also be true. Many investors can buy shares of a company if they see great potential behind an idea. This is great for new companies. The stock market is often perceived as a big scary abyss of money that eats unsuspecting investors alive and is the path to magnitude of wealth. The modern stock market often bases the value of a company off its potential earnings down the line. This means that relatively small companies can earn millions or even billions if investors think they can succeed in the future. So then, if a company wants to sell their shares, they need a place to do it. Enter the stock market. Companies list shares by selling them through an initial public offering or IPO on an exchange. This essentially changes the status of a company from a privately held business to a publicly traded one. IPOs can let co founders cash out their stake or just let the company raise money. Once a company's stocks are listed on an exchange, the public can trade them. Usually, prices will fluctuate based off of public opinion, but the more concrete trends and fluctuations are usually dependent upon a company's earnings and operations. These can be measured by PE ratios or price to earning ratios, as well as a variety of other metrics. This is usually where casual investors get scared and their eyes start to glaze over. But fear not, it's not as complicated as it sounds. But the modern stock market is significantly more complicated than its original incarnation. So, how do companies and investors use the market today? Let's imagine a new coffee company that decides to launch on the market. First, the company will advertise itself to big investors if they think the company is a good idea. They get the first crack in investing and then sponsor the company's initial public offering or IPO. This launches the company onto the official public market, where any company or individual who believes the business could be profitable might buy a stock. Buying stocks makes those investors partial owners in the business. Their investment helps the company to grow as it becomes more successful. More buyers may see potential and start buying stocks as demand for those stocks increases. So does their price, increasing the cost for prospective buyers and raising the value of the company's stocks people already own for the company. This increased interest helps fund new initiatives and boost its overall market value by showing how many people are willing to invest in their idea. However, if for some reason a company starts to seem less profitable, the reverse can also happen. If investors think their stock value is going to decline, they will sell their stocks, and with the hopes of making a profit before the company loses more value. As stocks are sold and demand for the stock goes down, the stock price falls and with it the company's market value. This can leave investors with vague losses unless the company starts to look profitable. Again, this seesaw of supply and demand is influenced by many factors. Companies are under the unavoidable influence of market forces such as fluctuating price of materials, changes in production, technology, and the shifting costs of labor. Investors may be worried about changes in leadership, bad publicity, or larger factors like new laws and trade policies. And of course, plenty of investors are simply ready to sell valuable stocks and pursue personal interests. All these variables cause day-to-day noise in the market, which can make companies appear more or less successful in the stock market. And in the stock market, appearing to lose value often leads to losing investors and in turn losing actual value. Human confidence in the market has the power to trigger everything from economic booms to financial crises, and this difficult to track variable is why most professionals promote reliable long-term investing over trying to make quick cash. However, experts are constantly building tools and efforts to increase their chances of success in this highly unpredictable system. But the stock market is not just for the rich and powerful. With the dawn of the internet, everyday investors can buy stocks in many of the exact same ways a large investor would. And as more people educate themselves about this complex system, they too can trade stocks, support the businesses they believe in, and pursue their financial goals. The first step is getting interested in pursuing your own financial goals. For the beginning investor, the best way to learn the stock market and to get involved is to take a few bucks. You are okay with losing those bucks and getting your hands dirty and invest wisely. So as always, if you found this helpful, click that like button. Leave comments and questions below. Also share this video with your friends and do subscribe to my channel.